15. Well, let's talk about what exactly is going to be on the mind of the Reserve Bank, as well as what's the view for the rupee and the bond. We're joining in is DK Joshi, Chief Economist at Crisil Research, who now joins in live on the show. Thanks very much for being with us. I'm going to start off with Mr. Joshi, your stance from the Reserve Bank, because it really remained hawkish the last time around, and it really matched that easing stance that it had been taking for many quarters. Given that they have categorically mentioned now that further easing is not going to come easy, what is your expectation in the next monetary policy?
Well, I think as of now, we are expecting 25 basis interest rate cut, repo rate cut from RBI in the rest of the fiscal year. I think if inflation surprises further on the downside, which it has so far, I think maybe another 25 basis point. I think beyond that, we don't see RBI cutting interest rates, because now I think they have very explicitly stated that they want to maintain inflation at 5%. So I think that means that reduces the scope for further rate cuts. So I think we should see 25 to 50 basis point further rate cut in this fiscal year. Beyond that, I don't see RBI cutting interest rates.
We have been seeing the inflation trajectory easing, but do you think that, the pace of decline is likely to be a little subdued in light of the kind of pressure that it's going to see from the supply side bottlenecks, and perhaps by the second half of the year, the movement or the gradual decline is not going to be as steady?
That's true. I mean, we are going to see a petrol price hike very soon. And apart from that, I think a lot hinges on what happens to monsoons. And I think so far the signals are good. And if monsoons remain normal, I think at least the food part of the inflation will remain under control. And so overall, I think what we should see is the first half will see inflation coming down quite sharply. And the second half will see it marginally increasing. So I think overall, and towards the end of the fiscal, it could be 5.5%, anywhere around that range. So it will be a kind of a U that will pan out for this fiscal year. And I think my sense is that there are pressure points on inflation, particularly from electricity prices, from diesel prices, which will continue to rise. But I think they are getting offset by a very weak demand in the economy. The private consumption demand is extremely weak, and that's reflecting in the core inflation, which has come down so sharply. So I think overall, and that is offsetting whatever increase in inflation is taking place. And the CPI also has started moderating now. So overall, I think we are going to see inflation dip quite significantly this year. But I think if our central bank sticks to its target of 5%, then I think that is what that will keep them from cutting interest rates further. Though we will see inflation lower than what we have seen in the last couple of years, but still not below the comfort level of RBI or the target level of RBI on a sustained basis. So I would say that's why I said earlier, only 25 to 50 basis point is what should be expected realistically.
If the RBI sticks to what the commentary sounded like at the end of the last policy, Mr. Joshi, what happens then to the yields? Do they harden, or you don't think that will happen?
Well, I think it will be, I think if, as I said, I mean, if inflation surprises further, then I think either they won't harden. But yeah, yields, the bond markets have definitely priced in further rate cuts, and also they priced in the inflation downward movement to continue going ahead. And so you could see the yields declining a little bit more, but I think on a sustained basis, I think I don't see a very sharp decline in 10-year bonds. I mean, it might decline for a short time, but I think then again it tends to pick up. I mean, if I take you back to 2009, I think when the 10-year bonds had suddenly come down to 5% for 1 or 2 months and then again gone back, I think we'll see something similar. I think it all depends on inflation trajectory, which has been positively surprising as of now. So there is, I think, our initial call on 10-year bonds was around 7.7% by March. I think we have to revise it down because of the decline in inflation. But having said that, I don't see the yields coming down very, very sharply. I mean, I think right now the yields themselves have, the markets have priced in aggressive stance from RBI on interest rates, which is not evident from their statement. I mean, which is more cautious, which is considering the fact that there could be further pressure on inflation if the demand picks up. So I think given all that, some downside to the yield is there. Beyond that, I don't see that sustaining.
Apart from that, we're expecting the GDP numbers to be put out this Friday. Do you think that the slowing manufacturing, the overall uncertain external environment, as well as the sticky headline inflation is going to be a bit of a dampener when it comes to the overall number?
Well, I think overall GDP we expect around 4.6, 4.7%. I think which is below the average of 2012-13. I think from there'll be a marginal lift in 13-14. Only marginal because there are no significant drivers of growth visible at this juncture, as you rightly pointed out. I think if I add to that the investments which are sustainable driver of growth are not in action right now, and whatever lift we'll see is essentially going to be from the consumption side. So overall situation, I think growth remains weak. Inflation is coming down faster than expected, but we should also remember that growth has also come down much faster than expected, and typically growth impacts inflation with a lag. So low growth of 2002-03 is having a spillover effect on inflation, manufacturing inflation of this year. And the external environment will remain vulnerable, as we have seen. I think the current account deficit is going to moderate from last year, but not very significantly. Our call is around 4.5%. So the rupee movement will remain quite volatile. And even though we believe that there will be enough funding for the current account deficit in the next year, but the rupee will not strengthen too much. I mean, we only expect rupee to strengthen to around 54 by March 2014. So I think overall external environment fragile, growth weak, and I think surprise on the inflation front. I think that's the headline.
And what about the liquidity deficit? That continues to remain high. I know you said you expect a 25 basis points rate cut from the Reserve Bank, but do you think they may perhaps undertake a CRR cut also to tackle the liquidity?
Well, CRR cut, and also I think what we might see is that government spending increasing. I think that itself will infuse some liquidity into the system, because without liquidity the interest rate decreases by RBI will not get passed on to the system. I think as we have seen in the last couple of months, I think the bond yields have come down. The commercial the commercial paper rates have come down, but what has not come down is the bank lending rates. I think bank lending rates have declined only by around 20 to 25 basis points for the major banks, whereas the repo rate has come down much sharper. So I think the key issue is how fast the bank lending rates will come down. And I think that critically depends on how fast their deposit rates come down, and also how fast the liquidity in the system eases. So I think these two factors will determine the bank lending rates going ahead. And we do believe that liquidity will ease a bit going ahead, and that will also transmit it into the lending rates of the banks.
We'll leave it at that. Thanks so much for joining in today and giving us that perspective. CSE numbers are out.